This video is going to discuss double tops and double bottoms. Very high probability areas to look for counter trend trades. The market works its way up, comes down, and sometimes takes a while to get back to the high. This is a double top, and usually the second top is a great place to look for counter trend trades. We have trading systems that's devoted to looking for double tops and double bottoms, and also looking for divergence. Watch our divergence counter trend trading systems to see that method in action. A double bottom simply looks like this. The price comes down and comes down again. Usually 30 minutes to an hour or longer apart is better. And then the price usually reverses. The nice thing about this system of looking for trades in the opposite direction is if you buy there, you can put your stop right underneath the low, because if price fails to reverse and go up off the low, then if it does go down and breaks this low, it's likely to go down a lot, so you can have a super tight stop. Double tops and double bottoms aren't always exactly to the pip the same high or low. For example, the market can work its way up, pull back, and come back up like this. I would still consider this a double top, even though price maybe isn't exactly at that level. Or as the price comes down, it's real close to that level, but not exact. Price reverses. But for the most part, it's an area where the price hits it twice, and then the market reverses. Now, while reviewing double tops and double bottoms, it's important to notice and to understand that triple tops tend to not work as a counter trend method. For example, if the market comes up, pulls back, comes up to the area again, and especially if it can't get under that previous low, the third time it hits that level, first time, second time, third time, usually there's no more selling at that level. Whoever sold the first time and the second time, they're getting a little nervous because the market's not going their way, and when it comes back and breaks out right here, their stops are right above the highs, and as it's coming back up, they may decide to bail on the trade with a small profit here, and that causes the market to shoot up. So don't short triple tops, don't buy triple bottoms. And in fact, we have a trading system that's called the triple top, triple bottom breakout system. So again, don't short triple tops, don't buy triple bottoms. So the market comes down, that forms a double bottom, and especially if it can't get over the previous swing high, it comes down again the third time, do not buy. And in fact, if the market breaks that level, you probably want to look to sell it, because it has a high odds of continuing to a lower level. Let's look at some examples of double tops, double bottoms in action. Here we have a pretty good example of a double top. Again, it didn't go exactly up to the previous high. You can see it was less than 10 pips away, but price went up, there was some selling, it came down, and then it came up again, and buyers weren't willing to take it higher. If you go short somewhere around this area, you can put your stop right above the high, because if it does break out, it's likely to continue up. Here's a great example of a double bottom. The market comes down, comes back up again, comes down, doesn't break that low. This is a perfect example of a double bottom, and then price reverses. Also here, earlier in the day, comes up, hits it again, can't break it, and the market goes up. This is also a perfect example of why you don't want to buy triple bottoms. It came down again and shot about 15 pips underneath there, probably causing you to have a loss there if you had bought the triple bottom. So never buy triple bottoms, never sell triple tops. Here's a great example of a double top. Market comes up, makes a high, pulls back, comes up again, and again, slightly higher highs than before, or slightly lower highs than before, or exactly equal. doesn't make any difference. As long as it's within 5 to 15 pips of the previous swing high, the better. And also preferably with longer distance in between. If it comes up, pulls back, and within an hour hits it, it's less powerful than if it takes it 2, 3, 4, 5, 7, 10 hours later. Here's an example of a double bottom. The market comes down, shoots up 25 pips, comes down again, can't break that low, and explodes up. Here's a slightly higher high, double top. The market goes up, comes down, comes up again, barely makes a higher high, goes less than about 10 pips up, and then the market comes down and goes sideways before reversing the next day. Here's not the best example of a double bottom, but you can see the price comes down, comes back up again, comes down again, doesn't quite hit the low, is really kind of going sideways here, and again doesn't break the low. It's kind of an example of a wedge shape flat bottom combined with a double bottom together. You can see price came within a few measly pips of the low, and then it broke out and the trend reversed. Double tops and double bottoms at Fibonacci profit target levels are even higher probability. For example, this previous move up, if you drew your fibs on there, and you see somewhere between the 1.3 and 2 and 1.618 fib level, if the market comes up, pulls back, and is unable to go higher, that's a great place to look for reversals in price. As you can see, price came down. So the more extreme up or down the price is, after having made a big move, double tops, double bottoms are even more high probability places to look for reversal. And if you're a trend trader, places to look to exit your trend trade.